actually try this. Good afternoon. Good afternoon. Welcome to our 23rd annual Spring Henry George Lecture. My name is Aram Balagyojan, and I'm an assistant professor of economics and here at the Department of Economics and Finance. And I'm also a faculty coordinator of the Honor Society in Economics, ODE. Again, I'm excited to welcome you all to our 23rd Spring Henry George Lecture. Before I turn the podium to my colleague, Dr. Ghosh, who will formally introduce our speaker, our distinguished guest today, I would like to say a couple of words about the Spring or the Henry George program that we house here at the University of Scranton. So the Henry George program consists of two lectures, basically, two that one of which take place in the fall, and the seminar takes place in the spring. So both events are organized by the Department of Economics and Finance, and the spring seminar is also moderated and supported by Omicron Delta Epsilon, the Honor Society in Economics. So let me tell you a couple of words about who Henry George was. He is, as you can see, a 19th century guy. He is a 19th century philosopher, a political economist, social activist, writer, politician, who was a fierce advocate for economic justice and a fierce opponent of moneyed, corrupt power. The tenet of his philosophy, basically, was that people should own whatever they've created, and everything found in nature should belong to all humanity. In his great classic work, Progress and Poverty, he tried to explain how come there's so much poverty around the world. At the same time, the lion's share of the economic benefit is monopolized by only few. And you may actually think that, well, it's been a century and a half ago. I mean, why are we still clinging to the same old ideas? Well, the ideas and his philosophy advocated a century and a half ago are still as relevant today. If you think about modern America, the top wealthiest 1% of Americans, developed country, own about 40% of the overall wealth, while the bottom 80% hold only 7%. More sadly, about 15% of all Americans, that's 45 million people, today live under the poverty line. So the ideas proposed and advocated by Henry George are still as relevant today and continue to inspire politicians, social scientists, philosophers, economists alike. The financial support of today's event is generously, continuously provided by Robert Schachenbach Foundation, which was established in 1925 to promote the social philosophy and ideas advocated by Henry George, and we are all grateful to their continuous support. Before I turn the podium to my colleague, Dr. Ghosh, who will formally introduce the speaker, I would like to extend my gratitude to several people who made this event possible. It's first of all my colleagues, Dr. Scahill, Dr. Petsas, Dr. Pargianis, and Dr. Kalyaniotis, and Dr. Ghosh. I would also like to thank the student officers of Omicron Delta Epsilon, who helped tremendously to put this event together. Last but not least, I would like to thank our wonderful administrative assistant, Janice Macadon, and our work study, Angela Perry, who are really the executive power beyond our vision of this event. Thank you all. Now, one comment, a couple of kind of housekeeping comments that I'd like you to maintain. Please turn your cell phones off so that it doesn't disrupt the lecture at any time. If you have to take take any important calls, you can put it on vibration and take your calls outside of this lecture. That's one. So the lecture will go for about an hour, and there will be about 15 minutes left towards the end, so for your questions to be answered by our distinguished speaker. Please, remain seated until the lecture is completely over, because that's only the appropriate way of doing that. And now, without any further ado, please join me in welcoming Dr. Ghosh, who will formally introduce the speaker. Thank you.
Right here? Okay. Thank you. Dr. Balagyojan has given me less than 5 minutes to introduce someone that I have known for more than 40 years. But I'll do my best. I have introduced over the last 30 years or so many great economists to the University of Scranton community as part of the Henry George Lecture. Many Nobel laureates and other people that served as Council of Economic Advisors or in other positions of the government. But I can tell you that I have never had this much of pleasure in introducing someone that I'm going to introduce today, Dilip Mookherjee. Dilip is coming to you from Boston University, where he is also the director of Institute of Economic Development, a position that he has held since 1998. And before Boston, he taught at the Graduate School of Business at Stanford University, Indian Statistical Institute, and he has held visiting positions in Columbia University and many other institutions in the world. He was the past co-editor of Journal of Development Economics. He is the associate editor of American Economic Review and Journal of Development Economics now. He has written more than 100 scholarly articles in economics. He is the recipient of Guggenheim Fellowship, recipient of Mahalanobis Medal of Econometrics, and above all, is a fellow of Royal Econometric Society, an honor that is reserved for the very best in economics. He also has been the president of BREAD, the Bureau of Research and Analysis of Economic Development. And before all these things, he had his degree. He finished his PhD from London School of Economics, where he also had an MSc in Mathematical Economics and Econometrics. He had a master's prior to that from Delhi School of Economics in India. And before that, where it all started, he was at Presidency College in Calcutta, where I met him for the first time when we both walked into our very first class in economics, more than 42 years back. Now, if at this point you are trying to figure out how old we are, don't, because we skipped all our schooling. We went directly from kindergarten to college. We were boy geniuses. Right from the get-go, within few days, we figured out, like everybody did in our class, that Dilip is extremely smart and that he was destined to be a great economist one day. I'll tell you this because of the quirk in our academic calendar. After about 3 days of our classes started in our freshman year, we had a break of about 3 weeks coming. And one faculty member showed us a Principles of Economics text and told us that over the next 3-4 months, we'll have to finish most of this book. After the break, we came back and we found out that Dilip had studied the entire book, all 38 chapters of Principles of Economics, by himself, pretty much from cover to cover, and I suspect he did all the end of chapter exercises as well. And he was ready for the next challenge. He was that smart. And he was serious in everything. He was serious in doing microeconomics as he was serious in playing cricket outside the classroom. He was serious, but he never took himself very seriously because he was not very good in cricket. Sorry about that. But he made up for it by hard work and making sure that everybody else around him, whoever was on his team, pays as much attention to cricket and winning a friendly match with physics majors as he was. And if smartness and seriousness would have been the only thing, that would have been enough. But if, instead of me, anyone else from that class had been here to introduce Dilip Mookherjee to you, they would have told you one more thing, that Dilip perhaps was one of the most giving, most generous people that we have met. He was the smartest of all, but he spent countless hours to work with people who were not as smart as he was, making sure that they knew economics, they knew math, and they knew every other thing that is important enough to know, almost as much as he could help them out. It is this generous nature of Dilip, it is this compassion for the less fortunate, along with the smartness and his seriousness, his dedication, that would be shaping his professional life. This is why Dilip would write more than 100 scholarly articles, would establish himself as one of the best economists working in the area of development economics and anywhere else. And for the last 20 years or so, he devoted his attention maybe more to development economics and economic development issues than anything else. Economist and Nobel laureate Robert Lucas once said that economic development is such that if you start to think about this, you cannot think about anything else. And Dilip, perhaps over the last 20 years, while he did other things, did not leave development economics, did not think too much about other things. And we, the students of economics, all over the world, are better for it. Ladies and gentlemen, Dilip Mookherjee.
Thank you, everyone, for coming. Thank you, Satyajit, for a very generous introduction, bringing back memories. Thank you for this honor. It's a rare privilege to come to the University of Scranton, and I'm overwhelmed by the fact that on such a beautiful afternoon, you've given up what must be better pursuits to come inside a dark auditorium to listen to a lecture on justice and poverty. So I'm going to talk about market exclusion of poor farmers in West Bengal, which is where Satyajit and I went to college. So it's appropriate that we return to where we began. And this is based on joint work with Pushkar Maitra, Shandip Mitro, Alberto Motta, and Sujata Visaria. And our research has been funded by various organizations, agencies to whom we are very grateful. So what do I mean by exclusion of the poor? Well, this was laid out almost 20 years ago. The first time I read this lecture, I was, it just hit me in a certain way. This is James Wolfensohn, who was the president of the World Bank in the mid-90s. And he gave a lecture called The Challenge of Inclusion. And so here is an excerpt. He said, this is what the challenge of development is all about, inclusion. It is about bringing people into society who have never been part of it before. This is why the World Bank exists. This is why we are all here today at this, this was the annual meetings of the IMF and the World Bank, to help make it happen for people. So I was intrigued by this notion of, well, the absence of inclusion, which is exclusion. To what extent is exclusion important? How does it happen? What is the evidence for it? What does it imply? So to, give you a slightly better understanding, this is from a current World Bank website, where I think the theme continues. Poor people are often excluded from equal access to economic opportunity because of regulations, because they lack information, connections, skills, credit, and organization. Lots of ideas here. And because of discrimination. Empowerment strategies can help overcome many of these barriers that prevent poor people's entry into new markets and limit their productivity, despite their unremitting hard labor. So, the research questions. How much of this is really true? How much of this is really concrete? Do we really have evidence? Do we understand the phenomenon? What are its consequences? Okay, what are the causes, the underlying causes? And finally, of course, what can be done, if anything? So I'm going to focus, again, we have to be concrete. So we have to focus on a particular region of the world. And I'm going to focus on West Bengal. This is the state I come from. And I've been working there for over 20 years in various villages of West Bengal, trying to understand dimensions of rural poverty. And I'm going to be focusing particularly on people who are landless or are marginal landowners. So I'm going to describe and document. This is from a variety of research projects that my co-authors and I have been conducting over the last 7 or 8 years. I'm going to focus on 2 particular dimensions here. One is exclusion of the poor, of the landless and marginal land owners from agricultural wholesale markets. Farmers being able to sell directly in the wholesale market and instead having to sell to middlemen. And I'm going to focus on the relationship of farmers and middlemen. So that's the first. The other is exclusion from the opportunity to borrow from formal financial institutions. And I'm going to first document this, and then I'm going to try and analyze the phenomenon empirically to uncover the underlying reasons. Okay? And I'm going to try and report the outcome of various experiments that we've been carrying out with various policy options. And this is informative both in terms of the source of the phenomenon, the underlying reasons, as well as what can be done. Okay, so this gives you an idea of West Bengal. If you look at this particular map, this is a map of India, and West Bengal is this part in red, which is blown up over here. It's bordering Bangladesh over here, and Nepal over here. Okay. It's a population of 91 million, so is almost as big as the United Kingdom or France, of which 62 million reside in rural areas. In terms of per capita income and human development, West Bengal is pretty much in the middle of all the 28 states in India. So the monthly per capita consumption expenditure, non-PPP adjusted, I've given the rupee figures there, but if you use PPP adjustment, it amounts to about $2 a day. And the literacy rate is about 77%, as against 74% for the rest of India. Now, here are some numbers that will help you grasp, something about the livelihoods of these people and the composition of village populations. So this is from surveys that I have carried out earlier. This covers the entire state, but the rural parts of it. So we divide it into 4 groups depending on how much land they own. So landless, marginal, those who own less than 1¼ acres of cultivable land. I've ignored some of the other groups here just to give you an idea of the cross section. So the medium are people owning between 2½ and 5 acres. 2½ acres, by the way, is 1 hectare. And big, who are 10 and above. So if you think of these as 4 representative groups in the village, the percentage of the village population, 80% is accounted for by the landless and the marginal. Okay, so this is the vast majority of the population. What are their incomes? Farm income and total income. If I convert it into dollar PPP adjusted, the landless are living on $24 a month, which means less than $1 a day. And the marginal at about 79, so it's about $1.60 a day. Okay, so these people are poor, undoubtedly. And these 2 groups, for instance, about 10% of that population is going hungry. About 1/4 of them own televisions. In other words, 3/4 do not own a television. And particularly for the landless, the majority are earning their livelihoods by working, by hiring out their labor on the labor market. And the proportion of people who are actually cultivating their own farm is rising gradually. So you have to pretty much own your land in order to be able to operate a farm. There's very little tenancy. I'm going to tell you a little bit more about tenancy. Okay, what are the principal crops? Now I'm going to focus on 2 particular districts called Hooghly and West Mednipur. Hooghly is about 40-45 kilometers from Calcutta, fairly progressive, well-to-do. West Mednipur is more distant on the western side, much more backward. So we're looking at 2 states at opposite ends of the spectrum. And these 2 states are particularly important because one of the main ways that people in these villages dream of getting ahead is through potato. Okay, why is that? So if you look at the principal crops here, potato accounts for a very significant part of cultivation. It is, I don't know how many of you know about potatoes, they're cultivated only once a year. It's planted around the fall, between October and December, and it's harvested about 3 months later. Whereas the other crops, sesame and paddy, are planted throughout the year. Paddy is sown twice and sometimes 3 times a year. So this is the cropped area per year. But when it's the fall season and the winter season, potato is the most important crop. So paddy 3 times, you divide this by 3 and you get an acreage which is smaller than potato. And paddy is not grown at the same time as potato. And in terms of the amount of work that people are putting into various crops, potato is the highest, 28 hours a week of family labor, as compared to 12 for sesame and 19 for paddy. This is a measure of how much income they're earning from growing these crops, the value added per acre. And you see in the case of potato, this is again in Indian rupees, 15,000 compared to 4,000 for sesame and 4,000 for paddy. So potato is about 4 times more productive. Okay, so it's the high income crop. That's why people are dreaming of cultivating potato. However, potato also involves, so this is the standard deviation. Standard deviation which gives you an idea of the variability of the crop, which is also about 3 times that of the other crops. So it's a high risk crop. And the sources of risk are various. The price fluctuates a lot from year to year. I'll show you some numbers on that. The yield can fluctuate depending on soil conditions, and the weather can fluctuate. So for all those reasons, potato is a high risk but high value crop. And countless studies of poverty in India and Africa have shown that one of the major pathways out of poverty is diversification into cash crops. Okay? And so potato is the shining example of that in West Bengal. So a lot of what I'm going to do is focus on potato and what makes it possible for these poor people to cultivate potato. Okay, this is just to give you an idea of, these are paddy fields, and this is another crop, jute, which is being grown. It's a green and lush area. Now, just in terms of background, in terms of the major policy reforms that have been carried out over the last 40 or 50 years, around the time that Satyajit and I were finishing college, there was a left front communist party that came into power, democratically elected. And they carried out a pretty ambitious land reform. And they also created a system of functioning village government. And partly as a result of that land reform, now most of the farms are owner cultivated. More than 90% of the farms are owner cultivated. So very few of the poor are actually tenants. There is some leasing, and you'll see that in the data shortly. But the tenants are also protected through a registration program. So they have the option to register tenancy contracts. And once you register your tenancy contract, you're protected from being evicted by the landowner, and you are entitled to 75% minimum share. The local governments that were created have taken a lead role in building infrastructure that's important for agriculture. There's been a lot of growth in irrigation, both medium and minor irrigation. A lot of roads have been built. These local governments also deliver agricultural extension services. So these are, of course, resources that are not available in many other parts of India or many parts of sub-Saharan Africa. But in West Bengal, it turns out, because of this left-front government that was in power for about 3 decades, I think infrastructure and land are no longer kind of the burning issues in agriculture. There was also significant, it's not just the public sector, there was also private sector. There was a lot of growth of private irrigation, enormous growth in tube wells. And there are also lots of cold storage. You drive around this area, and virtually every 5 kilometers, you'll see a huge silo, which is actually a cold storage where farmers can store their crops. So infrastructure, in short, is not a problem. And I have done earlier work with Pranab Bardhan showing that actually there was a green revolution in West Bengal in the, between 1980 and 1995, where incomes from land nearly doubled. Most of it accrued to the poor. And it was accompanied by a diffusion of high-yielding varieties of rice, okay, whose yields are about 4 or 5 times that of traditional varieties. So what are the problems of farmers? So I survey farmers, and I ask them, so what are your problems? And mostly they say, we want to be able to grow high-value crops, like potato. So I ask them, what are the main problems you face in increasing cultivation or incomes from potato? And they say, well, the first problem they talk about is that we can't sell the potatoes at a remunerative price. Okay? The second problem to talk about is the high cost of good quality seeds. And third, they talk about access to credit. So these are the problems I've been focusing on for the last 6 or 7 years, and that I'm going to talk about. Now, what are the problems in selling potatoes that the poor farmers face? One is, as I told you, the potato crop is harvested once a year, around March and April. But, of course, potatoes we have to eat 3 times a day, 12 months a year, all year round. So, but all the potato is coming out of the ground once a year, so it has to be stored. And at the time that it comes out, the price drops. There's a huge oversupply at that time. Now, if you're poor, of course, you want to get the field ready for the next crop, which has to be planted within 15 days of the potato harvest. You want to plant paddy. So you need a lot of credit for that. So if you're poor, you don't have access to a lot of own funds, you don't have access to a lot of loans, you are forced to sell your potato crop at the harvest time when the price is very low. So one of the problems is being able to store the potato and sell it later in the year. As I told you, cold storage facilities are not the problem. Infrastructure is not the problem. What is the problem? It's credit. Okay? It's hard for them to be able to find the liquidity to be able to store potatoes. So that's one issue that I'm going to come back to later. Second, they, by and large, sell not directly in the wholesale market. They sell to local village traders, middlemen. And they keep complaining about, we don't really get a good price. These guys don't give us a good price. So why don't they get a good price from the local middlemen? One of the factors is that they lack information about prices in wholesale and retail markets. So downstream, the potato is going to be bought by the middlemen and resold in a wholesale market, which is within about 8 to 10 kilometers, not far away. And they don't know what price their own crop is being resold, perhaps the next day or the same day. And neither do they know what happens down the supply chain as it hits the retail market, goes to Kolkata, goes to neighboring states, what the prices are in those retail markets. So if you are trying to sell something and you don't know how much that object is worth to the buyer, okay? You don't know exactly how much profit or surplus he's making, okay? So you don't know how hard a bargain to, because the buyer will always keep complaining that, well, you know, price is terrible, you know, times are bad, and I can't give you a better price than this because I have to make a living too. So if you don't have that information about what price your crop is being resold, it lowers your bargaining power. And moreover, the lack of information, if you do manage to hold on to some potatoes, if you store it, you've got to decide when is a good time to sell. And you know, this is very much like handling a stock. You hold on to a stock, when is a good time to sell a stock? Okay, access to information about price movements is very important. And these guys are not that well informed. So there are lots of fluctuations in prices, short-term fluctuations in prices based on access to information, which these people don't have, which the traders have. The traders are constantly calling, you know, people they know in Calcutta and various traders and so on. They get rumors and, you know, things that may be happening in the government that may cause the price to go up. You know, there's going to be a transport bottleneck somewhere, and they can anticipate that the price is going to go up and they're going to move potatoes at short notice and make a killing. But the farmers don't have access to that kind of information. So, but of course you talk to the middlemen, and the middlemen say, no, we hardly make a living. You know, we just about get by. So it's very hard to figure out how much exactly these middlemen are making. So the first part of this project, which we started in 2006, was trying to figure out what exactly the margins of these middlemen are. And of course, they don't want to tell you. Well, so these are numbers from the project. Let me tell you, so this, just figuring out these prices, you would think information about prices is easy, right? Because prices, wholesale markets, retail markets, these are organized markets. You know, how difficult can it be? You know, I mean, here I was walking around the management school and I was seeing this very impressive trading room, and you know, you have prices on a ticker tape and so forth. You know, that's easy, right? Not so easy over there. Why? Well, it turns out the middlemen, you know, that you don't have anything like an organized market. You don't have a centralized market. Okay, the middlemen in turn go and sell to a wholesaler, and that's kind of an arm's length sort of. It's a bilateral relationship. They go inside a closed door, they make a deal, and they come out. And neither party wants to disclose to anybody else what price was transacted in that room. So it's very hard for anybody else to figure out what the price was. So how did we get to figure out the price? Well, there are these brokers. Okay, so when that transaction has to go through, these traders, they have their assistants and their accountants and so forth. We had to bribe them. So every evening, we had to pay them enough, and we placed people in we made contacts with vendors, they're called vendors in the local markets, in various wholesale markets, in the retail markets, both in Calcutta as well as in neighboring states. Okay, and we paid them to call us every evening at 8 o'clock what the price was that particular day. They called in the price to us, And I'll tell you more about what we did with that information. But that's how we figured out the price. And then we did a survey of the farmers, and we monitored transactions. We've been doing this for the last 3 or 4 years, and I'm going to show you data for various years since then, averaged for the year as a whole. So here's the wholesale price, harvest and post-harvest, 2008, 2011, 2012. And this is the farm gate price, which is what the farmer received. And by the way, this is, based on, these are complicated transactions. Each farmer is making maybe 8 or 12 transactions in the year, and we have about 4,000 farmers in our survey. So we are tracking about 16,000, 20,000 transactions here. And a lot of these transactions involve payments at multiple stages. There's an advance payment, a subsequent payment, and so forth. So it's not easy to get hold of these prices. But this is what we find. By and large, and we calculate transport costs, handling costs, and storage costs that the middlemen would incur, or the farmers that sell directly to the market, there are about 10% of them that do. From that, we can estimate how much the traders must be spending on these intermediate costs. And then you back out these costs, and you can calculate what the middleman is making. And this is as a proportion of what the farmer received. And basically the proportions are about, 2008 was a bad year. Prices of potato kind of collapsed that year. It was about 4.83 at the harvest, and post-harvest 4.87 Indian rupees. In normal years, 2011 was more like a normal year, 8 and 11. And 2012, those of you know have been following the news in India. In fact, food price inflation has been a major problem, and in particular, the prices of potatoes and onions have gone through the roof, and you can see it here. It became 21 rupees in the second half of 2012. So these price movements are pretty much driven by exogenous events. This is based on what's happening in the rest of the economy, demand from other states, other government policies, and so forth. The macroeconomic situation. The farm gate price is something that's getting determined as a result of bargains being made here. And the farmer is getting about, you can see, about 50% of the wholesale price in 2008. And the proportion becomes even lower in 2011 and 2012. The middleman is making, with the exception of the post-harvest crash, 2008, about 80 to 100% of what the farmer is making. Okay, this is the net return of the middleman. Okay, so these middleman margins are huge. The other thing to notice is that as what we call the pass-through of the increase in market prices. When the market price increases, let's say the retail price increases, the fraction of that increase that is passed on to the farmer is very low. So, you saw the price go from 4.8 in 2008 to double that, or more than that, 2011. But how much did the farmers gain from that? Okay, it went from 2.3 to about 3.9. Okay, look at the change from the harvest to the post-harvest. It went up by 3 rupees, harvest to post-harvest. How much did the farmer get out of that? 0.07. Okay, it went up by 11 rupees in 2012. How much did the farmer get? 0.07. So almost all the gains from the recent food price inflation went to the middleman. Contrast this with the pass-through from the retail level to the wholesale level. And there we've run regressions. You do it both across years and within years, and the regression coefficient is almost 1.00. There's 1-for-1 pass-through of retail prices to wholesale prices. But from wholesale prices to the farmer, the guy who's actually producing the thing, is about 4 or 5%, as against 100% at the wholesale level. So what does this imply? First, these marginal potato farmers have very low earnings. If they could sell at wholesale prices, if they could themselves participate in the wholesale market, you would eliminate the middleman margin, and their earnings would double. Okay, they would not be living at $2 a day, they would be looking at $4 a day. They gain little from upward price movements, resulting from, so let's say, for instance, there's been increasing exports of potato out of West Bengal. And part of the reason why you see the potato price rising that way is because of the increasing exports. All the gains from exports are not going to the producers, it's going to middlemen. And what this means is that farmers have low incentives to cultivate potato. Now you would expect that as the price goes up, normal 101 economics, the supply should rise. But why will the supply rise here? Because of the price increase, nothing is going to the ultimate producer. So there's going to be no output response. And if there's no output response, that tells you why, in fact, it's very hard to control food price inflation. So potentially, what we are seeing here, we are potentially have serious implications here for the growth of agricultural productivity, for the reduction of poverty, and for the distribution of gains from, let's say, globalization or macroeconomic inflation. Now, the question, why? Why are farmers getting such a raw deal? Well, here are possible reasons. And the research question is figuring out which of these is really important and to what extent. First, I told you about the lack of information they have vis-a-vis the traders they're selling to. Asymmetric information. Second, the farmers are relying, perhaps what's happening is that, as you can see, the potato price fluctuates a lot across years. And these farmers are poor, very vulnerable, so perhaps the traders are providing some kind of insurance. As you can see, there's some kind of a floor to the price that the farmers are getting, even in bad years. So maybe the huge margins are kind of an insurance premium that the farmers are paying the traders for that insurance. So that's a possibility. Third, a lot of the farmers, they may in fact be borrowing to finance the cultivation of potato at the planting season. They have to rely on loans. And they borrow from these traders. So you rely on the guys you sell to for credit. So maybe some of this is kind of a hidden charge for that credit. Maybe the traders provide useful services. Checking quality, I'll talk a little bit more about this, but checking the quality and the quantity of potatoes is a non-trivial task. Potatoes are transacted in 50-kilogram bags. There are 6 varieties of potato, and even within each variety, you can have high grade, ordinary, and low grade. There's a different price for every variety, for every quality level. So the potatoes have to be inspected. They have to be sorted. Okay? The traders do a lot of that. So maybe that's a very useful service, and of course they have to be remunerated for that. Maybe traders do what we think of as the function of traders. They reduce search frictions. Okay? The buyers are coming in from the neighboring state or the retail markets, and they're matching them to local farmers. And finally, there's possibly limited competition. Okay? Perhaps there's collusive behavior amongst the local traders, and perhaps the farmers being excluded from the wholesale market is part of the story. So it's a research question. How important are these various factors? So we set out to try and understand this, and we started by trying to figure out how important asymmetric information is. When we asked the farmers, how do you know what the wholesale price is? They said, well, the trader told us. Why? In this day and age, information is easy. Most of these guys have cell phones. Of course, at that time, in 2006, cell phones were just being introduced in rural Bengal. So not everybody had cell phones, but your neighbor or somebody else you know in the village has a cell phone. And what does it take to make a call to somebody and figure out the wholesale price? Well, the problem is, as I told you earlier, the wholesale transactions, when the village trader resells in the local market, it's not on an organized exchange. It's a pairwise deal with another wholesaler at privately negotiated prices, which neither party has an incentive to disclose to anybody else. Okay, they're all worried about, the tax man coming and figuring out how much they're earning. So we asked, what would happen now if the farmers were to be given information on what these wholesale and retail prices are on a daily basis, in real time? And if this is really responsible for a low bargaining position, then there is actually scope for something to be done. This is something the government can do very easily. Provide information, disseminate information about wholesale prices and retail prices to farmers. Okay, so we conducted a policy experiment in the year 2008. We actually piloted it in the second half of 2007. Lots of sort of practical details, on the ground details have to be sorted out. We kind of managed to iron out all those problems by the beginning of 2008. So for the entire year of 2008, we conducted an experiment. 72 villages were drawn randomly from these two districts. And there's a paper on my website, which is a write-up of the results. What we did is, as I told you earlier, we paid these wholesale brokers, the vendors, to inform us of daily transaction prices for leading potato varieties in various wholesale and retail markets. We chose 24, one-third of the sample villages, randomly, and gave them a public information treatment, where these prices we called in to somebody who lives in that village, who put it up on a public notice board. One-third were chosen for a private information treatment. So we gave cell phones to 4 randomly chosen farmers in each village and relied on gossip to spread the news. And then the remaining 24 villages were used as a control. And of course, we made sure that these villages were at least 10 kilometers distant from one another so that the information in a village which received information would not sort of leak into the other villages. And then we carried out farmer surveys to calculate potato cultivation, production, storage, and sale details for 50 farmers in each village. So this is, give you an idea, this is a grocer. This is Mr. Grocer. This is Shondip, who's my co-author, who's been managing our project on the ground. And well, this is not coming up all that well, but this is the notice board. Okay. Now let me blow it up for you. Here is the notice board in Bengali, for those of you who can read Bengali. What it says is potato market price. This is Bhandarhati market. This is a wholesale market. This is Kananodi Bajar, which is another market. These are the 2 markets in the neighborhood. Kolkata, this is the retail market. The 2 leading brands, Jute and Chandramukhi, and then you can buy either ready or a bond. I'll tell you later what a bond is, what a potato bond is. But for each of these on different dates, okay, this was the price. Okay, and the price for the last 2 weeks was displayed in this fashion. So that was the public information treatment. This is the private information treatment. So here is one of the lucky recipients of a lottery, won the cell phone. We kind of blocked it to make sure that they didn't receive phone calls from everybody else. Okay, and then it could only receive the calls that were sent from our information booth. Okay, so after all this work, and you collect all the data and you analyze it, what is the effect on the farmer's price or on the volume of transactions? 0. That's the average impact. But we did get an impact on something, on the pass-through. At the rate at which increases in the wholesale price was being passed on to farmers. So how are these 2 statements consistent? So it must be that when the wholesale price was low, if you were informed as a farmer, you got a lower price than you would have got had you not been informed. You're actually worse off being informed. And the converse was true when the market was up. So what it did is increase the volatility of farmers' earnings. So the net effect on the farmers was negative. These are extremely risk-averse people. There's no average impact on your income, and the variance of your income from potato has gone up. So we were astonished. So were the farmers. They had also expected, whenever we told them about this experiment, they thought this would do wonders. And the traders, they hated us for it. They wanted to block the experiment. In some villages, when we put up the notice boards, they would come and tear it down in the middle of the night. We sometimes had to bring in police, local police and the local government to protect these notice boards. So all that was for us a very good sign up front, okay? But somehow it didn't happen, what we had hoped and expected. But we learned something from this. What did we learn? Well, one thing we learned, very important, is that we can use these findings to reject the hypothesis that the local traders were providing price insurance to farmers. Because this would have required ex-ante contracts. You've got to have an explicit or implicit ex-ante commitment to purchasing at a certain quantity at a certain price. When it is the case that the wholesale, the prevailing price at which the middleman is going to be able to resell is going to be something. Well, how do you know what the wholesale price is? As reported by the trader to the farmer. And of course, you've got to here make sure that the farmer has an incentive to report it truthfully. So those of you who've been studying economics of asymmetric information, in that kind of a context, to keep the trader honest, when he says that the wholesale price is low and times are not good, to keep him honest, you have to lower the quantity at the same time. So when you actually remove the asymmetric information, you don't have to reduce the quantity so much because you don't have to worry about the honesty anymore because now the price is common knowledge. So the quantity traded should go up on average. And it didn't because the average effect on quantity was 0. Moreover, asymmetric information is an impediment to the insurance. So when you remove that impediment, insurance should have increased. But we saw the opposite. The farmers' incomes became even more variable. So we could definitively reject the hypothesis that the traders were providing an insurance function. And in fact, whenever we interview either farmers or traders, they unequivocally affirm that there is no ex-ante understanding commitment whatsoever. It's always ex-post bargaining. Okay, so the low bargaining power of farmers cannot be explained either by asymmetric information or by insurance. What about credit? This also we can rule out. How? Well, turns out when you survey the farmers, find out about their loans, who they're borrowing from, only 30% of the farmers borrowed from the same trader that they sold to. Sorry, that's a typo. And then when you look at the farmers who borrowed from the trader they sold to with other farmers, there's no significant difference in price at all. So there is really no inbuilt price charge for the interest in the pricing of the crop. And in fact, you can recalculate everything, building an interest cost of advance payments. I'll omit those details. But basically, you can do calculations and definitively rule out the credit explanation. So that leaves limited competition. So we have to explore that in more detail. So you start thinking about that. So now, what are the outside options of a farmer when he's negotiating with any given trader? What can he do? So this is a trader from his own village. So if he says no to an offer that is made by this trader, if he said no, he could go and approach some other village trader. Or he could go outside the village and try and negotiate with some trader outside the village. Or he could try and trudge the 8 kilometers to the wholesale market, find a wholesaler and negotiate with him. Or he could sell to an outside party, okay, maybe a corporate buyer, a supermarket retailer. Well, it turns out the third option just doesn't exist. Not a single farmer, I think maybe we found one farmer who had managed to sell directly to a wholesaler. Just one out of 3,500 farmers. Even when they take that crop to the wholesale market, they don't sell to the wholesaler. There's a trader who's sitting outside the wholesale market. You have to sell to him. And then he takes your crop and resells it at the margins that you saw. Why? So we interviewed the wholesalers. Saying, why don't you deal directly with the farmers? You are buying from these middlemen. If you didn't buy from the middlemen, but you bought directly from the farmers, you would cut your procurement cost by more than 50%. Why are you doing this? You know, it's your own loss. And the wholesaler says, I am not going to negotiate with an individual farmer. It's not worth my time to negotiate with so many small farmers over small lots of potato. And they refer to the village traders as aggregators of potato sales from different regions. And they say that, these guys have developed a relationship with the farmers. They verify the quantity and quality of potatoes supplied by each farmer. Each and every bag has to be inspected. They cut open. I've seen them do it. They cut open the bag. They take out one potato at random. They look at it. And then they weigh. If there is a lot, let's say of 40 bags, they'll choose one bag randomly and put it on the scales. And it's supposed to be 50 kilograms, but sometimes 48, 47, 46, and so on. So they'll make an adjustment based on that. So this is an important function that the middleman is providing for the wholesaler. So this is a time-consuming and laborious process. So these are, if you think of it, what happens inside a firm. You have assembly line workers working on the assembly line. They need supervisors to be able to evaluate who's working how hard. So that's partly the role of the middleman. And finally, as I told you, the fourth option doesn't exist. And I'm going to return to this later. Now, you want to check, how many village traders, how many traders in the same village do you have to negotiate with? And it turns out that there are lots of traders in any given village. And a farmer is not locked into selling to any particular trader. He has a choice of, there's usually at least 3 or 4 traders in a village. The median number is about 9. So you have other traders in the same village. So it must be the case, if these traders are making such a huge margin, that they're not undercutting each other. So there has to be some degree of collusion amongst the local traders. Search as a friction is unlikely to be important because the farmers and traders are coming into almost daily contact with one another. They all go to the local market on a daily basis and they're constantly exchanging price offers and counter offers. And news travels very fast within these villages. So perhaps tacit collusion amongst the traders within the village exists, and we are currently carrying out tests to rigorously check this. The second source, the second outside option that I mentioned earlier, is to go outside the village and try and negotiate with a different trader. That option, in fact, is exercised. So about 10% of the farmers we found actually rejecting the offer that was made to them by the local trader and going outside the village. And in fact, this sequential competition between inside and outside traders can actually explain the trading patterns that we observe. The facts I told you, I showed you about how it varies with the wholesale price and how it varies with the information treatment that we provided. So I'm not going to go into the details of this. So let me summarize why we think the farmers get a low price. The key factor is limited competition amongst buyers for farmer produce. It's not information, it's not insurance, it's not credit, and it's not search. So the fundamental factor is exclusion. Exclusion of the farmers from being able to sell directly to wholesale markets. Now, why is exclusion arising? Quality assurance is an important part of it, so that is a natural reason. But there are also unnatural reasons. There's collusion amongst village traders, and there are restrictions on retailers buying directly from the farmers. There are certain regulations, these are called APMC regulations, which prevent anybody who needs to buy from a farmer has to get an APMC permit from the government. So the government has regulated the entry of people who can buy directly from farmers. So what are the policy implications? First is an important negative lesson. Certain things won't work. Okay, we have thought information provision would work. We don't think it's going to. Provision of credit or insurance is also not going to help much. And perhaps what we really need is to encourage outside buyers to come and buy directly from farmers as an alternative to the traditional village trader. But the problem with this, if you've been following the debates on foreign direct investment in India and multi-brand retail, the traders are a very powerful lobby. So they have managed so far to block such reforms. And certainly in West Bengal, the Chief Minister has publicly declared that she will not allow this. So the prospects look pretty grim. Okay. Let me turn to the other dimension of exclusion that I talked about earlier. How am I doing for time? Five to 10 minutes? Okay. I need to speed up then. Okay. Okay, credit. Now, traditionally, everybody in villages has relied on the local money lender, okay, an informal credit. And since India attained independence in the late 40s, the Indian government has constantly tried to increase the flow of credit to poor farmers, but it has not succeeded. So it has created regulations where banks and non-bank financial institutions have to meet targets. A certain fraction of their overall portfolio has to be for lending to the rural poor. But all the studies so far have shown that these credit flows have not really reached poor farmers, the intended beneficiaries. Moreover, the loan recovery rates have been low. Most of these loans don't come back. And so much so that the financial security of the entire banking system was threatened. And so when the reforms, the liberalization reforms were taking place in the early 90s, they relaxed these lending regulations. Recently, the government has again stepped up efforts to increase the flow of lending to the rural poor, but I don't think they still know how to do it. Why? Well, first is the state banks have a bureaucracy that essentially is loan officers are people who are educated in cities and they go to these remote areas. They're outsiders to the local community. They cannot identify good borrowers. It's very hard for them to monitor what's being done with the money. It's very hard for them to chase delinquent borrowers and recover loans that are due. The poor lack collateral. So the financial institutions, especially given the financial strain they've been under, therefore have been increasingly relying on collateral. And collateral, as you know, solves all these problems of screening, monitoring, and loan recovery. But collateral is something that only the rich have. Private banks, they do not break even, also because they say that to create a banking system that goes into these remote areas, the transaction costs of that are not going to be high enough to be able to cover the whatever they're going to make, the variable profits they're going to make on lending to poor people. With the state banks, there's widespread cronyism and corruption. So bank officials are more likely to lend to influential local people, okay, who are likely to be landowners, large landowners. And then, every now and then, before an election, a politician wants to win votes by telling borrowers, you needn't repay the loans to the state institutions. So the end result is that the credit from financial institutions, formal financial institutions, does not reach the rural poor. Here again is a survey of sources of credit for marginal farmers in our districts. 66% of loans are from the informal money lender, 3% from family and friends, 24% from a local cooperative, and only 5% from a government bank. What are the interest rates? The informal market has an interest rate of 26%, and if you go down increasingly towards the formal sector, the interest rate goes down. The duration of the loans goes up from about 4 months to about 10 months. And on the other hand, the loans from the formal sector are highly collateralized, which is the main reason why poor people can't get these government bank loans. I was going to talk about microfinance, which you may have heard of. Why didn't microfinance figure in the previous table? Basically because microfinance has failed to provide loans for agricultural purposes to the poor. Let me not go into the reasons for the lack of time. Let me just mention one reason. Microfinance has used innovative methods to be able to lend to the poor. And two aspects are particularly important. They give loans for, let's say, 1 year. But the repayments have to be made in a very high frequency. You often have to repay on a weekly basis. So let's say you take a loan of $50 and you have to repay within 1 year. You have to repay $1 every week. If you have a repayment obligation like that, there is no way you can use it to fund agriculture. Because agriculture, as I explained to you earlier, you need a lot of credit in October for potatoes. Okay? And the harvest is going to come out 4 months later. You're not going to be able to meet the weekly payments in between. So one is the high frequency nature of the microfinance loans. The other is that microfinance uses lending to groups. And these groups self-form. And each person is liable for everybody else's loans in the group. So they're all going to monitor each other. But then it means that if I want to plant potatoes, and I'm in a group with Satyajit, he's going to come and not let me plant potatoes. And he's going to go and complain to the microfinance institution. He's planting potatoes because he's worried that if the potato crop fails, I will not be able to repay my loan. He will be responsible. So peer monitoring, which has otherwise good effects on loan repayments, discourages risk-taking. So for these two reasons, microfinance has not succeeded. So what do we need? We need, okay, let me just speed up a little bit here. Yeah, so we designed a new kind of loan product. We call them trail loans. So first, the duration of the loans is 4 months. The timing of the loans, we give it when the potatoes are being planted, and they have to repay it at the time of the harvest, 4 months later. There are 3 loan cycles a year. They don't have to sell the crop in order to repay the loan, but we can give them another loan at that point to enable them to hold on to the crop if they want to store it. We charge an interest rate of 18%, which is below the informal rate of 25%. So we lower the cost of credit. We create dynamic incentives for the borrower to repay the loan by telling them, if you repay your loan 100%, then we will give you a larger loan next time, in the next 4-month cycle. We'll grow it by 33%. And we started with a loan of 2,000 rupees in October 2010. And by the end of 2012, this had grown 4 times because of the magic of compound interest. So this is more than enough for almost all the farmers. Okay. And then we built in some insurance against low price or yield realizations on potato. We compared this product with a group-based product, where the loans had similar interest rates and durations as in the trail loan, but we asked 5% groups to self-form, as in traditional microfinance. Okay, and then we conducted an experiment with 24 villages that got trail and 24 villages that got the group-based loan. And the experiment just got over a few months back. I'm going to just show you very quickly results from the first 2 years, 2010 to 2012. And then we chose samples including those who got the loans and those who didn't get the loans to estimate the effect of the loans. Okay, very quickly, the trail treatment increased borrowing by 7,000, and the group-based loan also increased it by somewhat less. The cost of borrowing became lower. Okay, so we succeeded in increasing the flow of credit at a cheaper rate in both. What was the effect on potato cultivation and output? Acreage increased by about 1/5 in trail, but only by half as much in the group-based. This was partly accomplished by the farmers leasing in more land than they owned. Output increased significantly by a factor of almost 20% for the trail loan, and by 1/4 of that in the group-based loan. for the reason that I explained. This is the financial calculation, the return on the loan. The cost of production went up. What these guys want is credit for seeds and fertilizers. They managed to increase the cultivation cost because they were also planting on a larger scale. They increased their revenue by about 15%, and they increased their value added with the trail loan by about 20%. When you compare it with the group-based effects, none of these effects are statistically significant. This is the effect on different crops, and most of the effect is on potato. Okay, and you don't see anything on the other. If you look at total farm income, you have about a 25% increase in farm income as a result of the trail loan. We estimated the rates of return for these farmers. So trail succeeded in lending to extremely productive farmers with a rate of return of over 100%. Whereas the rates of return in the group-based was, again, statistically insignificant, not different from zero. So the trail loan, I'm not going to go into the details of how the borrowers were selected here. Let me move ahead. The loan repayment rates. The blue is the loan repayment rate across various loan cycles for trail. And we have a 98% repayment rate by the end of 2012, after 2 years, in trail. And this is the group-based product, which also attains a repayment rate of over 90%. But trail achieved a better repayment rate than the group-based. These are the loan take-up rates of the people who are offered the loan, how many actually took up the loan. And again, the blue is significantly higher than for the group-based product. Okay, so let me summarize. Two contexts where we have significant exclusion of landless and marginal farmers: crop marketing and formal credit. What were the underlying reasons for exclusion in either context? We have the so-called unnatural problems: collusion, corruption, political problems. Those are very hard to fix. Then there are the more economic, incentive, transaction cost kind of reasons. We also showed that there are significant consequences of exclusion: low sales price realization for farmers and the high cost of credit. By lowering the cost of credit, we enable these farmers to increase their earnings by about 20-25%. So what can be done? With regard to providing price information, not much. Agricultural marketing reforms, increase competition, etc., etc. But we have an organized trader lobby. And of course, also the middlemen play an important role with respect to quality assurance. So that's another challenge. But something can be done. More optimistic about the prospect of doing something on the credit front. The trail product really succeeded beyond what we expected. So our experiment showed strong potential to raise potato output and farmer incomes. And at the same time, I didn't tell you about how the borrowers were selected. We asked one of these traders who had experience lending to people in the community to become an agent of the financial institution. And we incentivized that agent on a commission basis. And the commissions he earned were based on loan repayments by their clients. So basically, we co-opted the traders. So it was win-win. The farmers gained and the traders gained. So I've been talking to various commodity exchanges that want to now create futures markets where farmers will participate directly. And we are working on plans by which, of course, the farmers, they can't trade directly on the futures market because the deposit that you need to become a trader is something they cannot afford. But again, the local traders will act as their agents on a commission basis. So more generally, I think there is scope and there is hope for encouraging market inclusion for poor farmers. The whole strategy has to be you have to co-opt the local traders and lenders. So in fact, in the recent debates on foreign direct investment in multi-brand retail in India, again, the press, the traders, everybody has been seeing it as a zero-sum game. But it's not a zero-sum game. So if Walmart goes into India, Walmart will not, again, they're outsiders to these local communities. They will not be able to go in and buy directly. They will have to hire these traders as agents. So it could be a win-win. So I think this is the central message of what we have learned, and I hope I have managed to communicate it to you. Thank you.
Dr. Mookherjee, thank you so much. This was a very stimulating topic for me in particular, and I'm pretty sure for the rest of the audience. I think we have about 5 more minutes for questions from audience. Are there any questions for Dr. Mookherjee at this point? Please raise your hand, if you had any questions. You have to turn it on.
You said it was win-win for the traders and the farmers. Are there any losers in the game, as the financial institutions lose it all?
I showed you repayment rates of 98%. And the interest rate on these loans was 18%. 18%. Commercial bank loans are 12%. So even if you build in, we've calculated the added transaction costs. This is going to break even for the financial institutions. But we worked, the capital that we raised for this was from our research grants. So we worked with a microfinance institution here as our collaborating partner. And so we didn't have to pay the cost of capital. So we actually have to test the financial viability of Trail. So right now we are trying to raise funds from USAID, and also trying to find a collaborative partner amongst the state financial institutions in India. And we want to scale it up. We want to go outside West Bengal. We want to try it on different crops. So there is a significant challenge yet. But direct answer to your question, I don't really, we're not even invading on what microfinance traditionally does, because microfinance doesn't finance agriculture, right? So it looks like there is just a niche here that can be exploited. And I really am not aware of anybody who's going to get hurt.
Any more questions? Dr. Mookherjee, I actually have one question on my own. I am wondering, who are the traders? Are they? It seems that competition among them will at least partially resolve the problem. Are they anyhow certified by the local government? How come farmers themselves cannot become traders?
Yeah, well, it turns out, in fact, traders are formally farmers. They are rich farmers. So you need two things to become a successful trader here. First, you need a startup capital, and you need startup capital of about 30,000 rupees, which is about yearly earnings for one of these poor farmers. So you have to be able to save that up. Now, if you're saving, let's say 5%, and that's an optimistic assumption that you save 5% of your income when you're that poor. It'll take you about at least 7 to 8 years to be able to save up and attain that capital. That's criteria number one. Number two is you have to acquire reputation. So as I told you, they have to build up a relationship not only with the farmers, but also with the wholesalers that they sell to. And it takes years of investment in those relationships. So it's not something that you can readily enter into that quickly.
Thank you. Thanks. Any more questions, folks? Tim?
Yeah. Could anything be done to artificially fix the prices to help the bargaining of the farmers?
you could fix the prices, but the problem would be to enforce them. The government, the last 2 years, 2012 when there was this high food price inflation, as well as 2013, the government said, how about if we go in and procure potatoes? What happened? It was a colossal failure. What happened is that the price of potatoes went up even further. And the reason is the government could not buy directly from the farmers. The government was forced to try and buy from the traders themselves. And they were doing this in the post-harvest season. So this just drove up prices even further, and all the gains, as I showed you in the 2012 data, went to the traders. So, simple-minded ideas such as, let's get in external competition, let's get the government in to buy directly from the farmers, not that easy to implement. Besides, in fact, the people from the commodity exchanges who are very interested in getting the farmers trading directly with the market, they have to solve the quality assurance problem. So whenever an outside party goes in and buys, you've got to make sure that you're not getting dud potatoes. So there is a quality inspection problem. So all of this makes the enforcement extremely difficult. Besides, as I told you, the prices, these are all bilateral negotiations. It's very hard for any third party to know what prices were transacted. So it's very hard to enforce.
One more question. Yeah, there's one question behind.
How did you end up choosing oral services for that?
Okay, thank you. There's something I didn't have time for. Yeah, in each village where trail was administered, we went into the village and drew up a list of prominent traders in the village who had been operating in the village for at least 3 years and had a certain minimum clientele base. And then we chose one of them randomly, and we approached that trader and we offered him this post of commission agent on behalf of the financial institution. This guy has a lot of experience lending within the community. We asked him to recommend 30 clients. And then we incentivized him by paying him a commission, which was 75% of the loan repayments. So he had an interest in recommending the most productive, the most creditworthy clients. And then we didn't lend to all of them. We chose a certain fraction. We chose 10 out of the 30 that he recommended. Because you also have to worry about all kinds of collusion that can take place between the lender. He could be bribed by non-credit-worthy farmers into recommending him. So there's a lot of thought that's gone into how you could, whether or not such collusion may be going on. And actually the evidence shows that there isn't any such collusion going on. So the evidence shows, as I showed you, the farmers that were selected had rates of return of over 100%. So the agents did select highly productive borrowers. But that question is absolutely fundamental.
Dr. Ghosh wants to ask.
Dilip, you talked about the wholesale price, the information that you are getting every evening at 8 o'clock and you're getting phone calls. How reliable those information were? How did you know that the data that you were receiving,
Yes.
the phone calls, that they were really the prices at which those transactions, the becoming close to transactions took place?
Yeah, that's a good question. What we have done, what we wanted to do was also survey traders. The traders did not want to get involved. We decided that we had to get them involved. So we got this USAID grant, and for the year 2013, we got enough money to bribe these traders. So for the year 2013, we surveyed these traders on their daily transactions throughout the year. That data is currently being cleaned. So I will have an answer for you, but we will match what the traders are telling us about their transactions with what their brokers are telling us.
Basically, you were deal with bribing to talk about possible corruption? No.
There was one
Yeah.
question.
I know that you mentioned that there were no losers as far as you know with the trail-based loan, but are the incentives higher for the traders to work on a commodity basis as opposed to the margins that they're making if they kind of collude among each other? Like, is that incentive higher for them to work for you guys?
No, this has got not the credit. The trail thing was a credit product, and it had nothing to do with the marketing side of it. So these traders are probably still colluding on the marketing side. And in fact, question that I think you were probably leading up to is, did the credit loans have any effect on the crop marketing? And the answer is no. So I think they're colluding just as before on the marketing side.
Well, thank you very much all for staying after the actual lecture was over. Thank you very much for attending this lecture, and this concludes our today's event. Dr. Mookherjee, thank you very much for delivering an intellectually charged lecture. Thank you.